Welcome back to the Deep Dive, where we try to make sense of the market's biggest puzzles. We dig into the sources, try to find the real story. And today, we are looking at a really stark contrast, wouldn't you say? A massive dichotomy.
We really are. It's a strange place for the market to be this October 2025. You could call it an unstable equilibrium. It's like, on one hand, you've got these big picture, long-term signals.
Fundamental value kind of stuff.
Exactly, strategic indicators. And they are just flashing bright red, screaming extreme caution, really loud alarm bells.
Okay, but then you look at the day-to-day stuff. The short-term picture.
Totally different story. The tactical indicators, the ones measuring, immediate fear or risk perception, they're signaling this deep, almost eerie calm.
How is that even possible? How can both things be true? That's the big question, right?
That is absolutely the core question for this deep dive. What the sources seem to suggest is that the market is priced. Well, it's priced for near perfect execution going forward.
Meaning everything has to go exactly right. Like earnings, inflation, geopolitics, the whole lot.
Pretty much. Which leaves, as you can imagine, a razor-thin margin for any kind of error, any mistake.
So it's like a Jenga tower that's way too high. Perfectly balanced for now, but super unstable.
That's a great analogy. As long as there's no wind, maybe it stays standing. But the second something unexpected happens, well, the fall could be really fast. And messy.
Okay, let's break this down. We should start with the scary part first, right? The strategic risk. The long-term valuation problem. Where do we begin?
I think we have to start with the most talked about, maybe the most extreme one right now, the Buffett Indicator.
Ah, yes, the big one. Simple concept, right?
Beautifully simple. That's its power. You just take the total value of all U.S. stocks, the total market cap, and you divide it by the country's annual economic output, the GDP.
So it's like a price tag for the whole U.S. stock market relative to the size of the actual economy. And it's harder to fudge with accounting tricks than, say, PE ratios.
Much harder. Less susceptible to corporate engineering like buybacks influencing earnings per share. It gives you a cleaner sort of macro view. So what's the reading?
Okay, brace yourself. What is it?
Right now, the Buffett Indicator is sitting at a truly mind-boggling 221.6%.
Whoa. Okay, 221.6%. Let that sink in. The stock market is valued at more than double the entire U.S. annual economic output.
And we know how dangerous that zone is, historically speaking. Warren Buffett himself, the indicator's namesake, famously warned that when this ratio gets near 200%, well, his words were, "You are playing with fire."
And we're not near 200%. We're way past it, 221.6%.
Decisively past it. Now, here's where it gets really kind of shocking when you look back.
Put it in context for us, compared to other bubbles.
Okay, think about the dot-com peak. Year 2000, massive bubble, right? That indicator topped out somewhere between, say, 140% and 160%.
Okay, so significantly lower than now. What about before the 07-08 crisis?
Even lower, around 110% was the peak then.
Wow. So we are currently, right now, October 2025, in territory that makes the dot-com bubble and the pre-GFC peak look almost modest.
Statistically speaking, yes. It's far more stretched. This isn't just a bit pricey. We're talking about historically rare air. It points to extreme optimism, maybe even, euphoria baked into prices.
So from a long-term investor's perspective, someone planning for the next, say, decade, what does a number like 221.6% imply based on the historical data?
Well, it implies a very, very high chance of really poor returns, like below average returns, possibly even negative returns after inflation over the next 7 to 10 years.
So the gains we've seen, they weren't just companies earning more.
Not primarily, no. A huge chunk of the returns over the last decade came from what we call multiple expansion. People just got willing to pay more and more for each dollar of earnings or assets.
Essentially borrowing returns from the future.
That's exactly the implication. And eventually that bill has to be paid. The multiple has to contract or earnings have to explode upwards in a way that's frankly hard to imagine.
Okay, let's bring in the other big valuation gauge to see if it tells a similar story. The Shiller-KP ratio. Cyclically adjusted PE. I like this one because it tries to smooth things out.
Right. The key is smoothing earnings over 10 years. It irons out the wrinkles of the business cycle, the temporary booms and busts, gives a more stable picture of underlying profitability.
And the current reading on the TP?
It's hovering around 39.5.
39.5, okay. And long-term historical average is somewhere around 17, 18?
Roughly 17.6 over the very long term. So yeah, 39.5 is well, it's way up there.
How far up there? Where does that rank historically?
It's basically the second highest reading ever. The only time it was higher was at the absolute peak frenzy of the dot-com bubble when it briefly touched 44.2.
So adjust for inflation, smooth out the earnings cycle, and we're basically as expensive today as stocks have ever been, except for that one specific moment of insanity 25 years ago.
That's what the data suggests. Yes.
Now, you've looked at the numbers. Quantitatively, what happens next when valuations get this high? When the CPE is up in this top tier, say, above 26 or so, what were the actual subsequent returns?
This is the really sobering part that, you need to internalize if you're thinking long-term. In that highest valuation group, historically, the average real return that's after inflation over the following 10 years was just 0.9% per year.
Less than 1% annually for 10 years after inflation.
Think about that. You take all the risk of owning stocks for a decade, ride the ups and downs, and your purchasing power barely grows. It's effectively a lost decade for wealth accumulation from broad market exposure.
And that's the average outcome in that expensive group. What was the worst case?
The worst historical outcome from that high KP starting point was an actual loss in real terms, losing MEDIC 6.1% per year, every year, for 10 years after inflation.
Ouch. Okay, that's the strategic reality check. Heavy stuff. Now, to be fair, there are counter-arguments, right? People push back on these historical comparisons.
Oh, absolutely. And we should mention them. You hear things like, well, U.S. companies earn more globally now, so GDP isn't the right comparison for the Buffett indicator.
Right, or that the economy has changed. More tech companies, less capital intensive, higher margins. So maybe higher valuations are justified now compared to, say, the 1950s.
And those points have some merit. The structure of the economy has shifted. Global profits do matter. They might help explain why the average valuation, maybe the fair KP ratio isn't 17 anymore. Maybe it's, 24, 25 now. But those arguments really struggle to explain the extremity we see today. They don't get you from a justified 25 CPE to almost 40. They don't justify a Buffett indicator over 220%. The current levels seem way beyond what those structural shifts can rationally account for.
Okay, so if the long-term picture looks that risky,
right,
based on history, why is nobody apparently worried right now? Why does the short-term picture look so calm? That takes us to the other side of this contradiction.
Exactly, the tactical tranquility. And the first place you look for that is the market's so-called fear gauge, the VIX index.
The CBOE Volatility Index. It measures expected choppiness over the next 30 days derived from options prices. Right.
That's right. It's basically the price of portfolio insurance. When people are scared, they buy protection, and the VIX goes up. When they're confident, they don't bother, and the VIX falls.
And the current reading is?
It's very subdued, around 16.6.
16.6. And the historical average is more like 20?
Closer to 20, yeah. So being in the mid-teens, this signals a lot of confidence. Very little demand for hedges. Options are relatively cheap.
Which leads to that dangerous feedback loop, the volatility paradox.
Precisely. When volatility stays low for a long time, people get used to it. They get complacent. They might take on more leverage, thinking things are safe. They sell volatility, assuming it'll stay low.
Setting the stage for a bigger shock when something finally does break the calm.
Exactly. The sustained low vol itself becomes a source of instability down the road. It makes the system more fragile.
And this lack of fear isn't just in the stock options market, is it? What about the credit markets? Sometimes they're seen as smarter, the canary in the coal mine.
Good point. We need to look at credit spreads, specifically the high-yield option-adjusted spread, or OAS.
Okay, break down OAS for us. What is it measuring?
It's basically the extra interest, the extra yield that investors demand to hold riskier corporate bonds, junk bonds, compared to holding super safe U.S. Treasury bonds. It's the market's price on the risk of companies defaulting.
So if investors get nervous about defaults, that spread widens out. They demand more compensation for the risk.
Exactly. And when they feel confident that companies will pay their debts, the spread tightens.
And right now?
Right now, it's very tight. The OAS is only 2.95%. That's 2.95%.
And what's considered a normal or stressed level?
Historically, a level below, say, 3.5% is considered tight, indicating low perceived risk. Stress usually starts to show up when it gets above 4%. So at 2.95%, the credit market is basically saying, we're not worried about defaults, even among the riskiest borrowers anytime soon. It's endorsing that calm, near-term outlook.
So let me recap the contradiction. We have valuation metrics like the Buffett indicator and KP ratio at levels only seen maybe once or twice before, screaming long-term danger.
Historically extreme valuation.
But at the same time, We have the VIX near historic lows and credit spreads incredibly tight, signaling almost zero near-term fear or perceived risk.
That's the unstable equilibrium. That's the tightrope.
And this combination, it feels familiar, doesn't it? Haven't we seen this movie before? High valuations plus low volatility.
I absolutely have. History provides some pretty stark warnings here. Think about the mid to late 1990s. Dot-com mania, valuations soaring, VIX generally low until it wasn't. And then 2000, 2002 happened. Or look at 2005 to 2007. Housing bubble inflating, stock valuations climbing, credit spreads tightening to incredibly low levels.
Right before the global financial crisis.
Exactly. In both cases, that specific combination sky-high optimism reflected in valuations, coupled with suppressed risk perception and volatility and credit, ended very, very badly, abruptly and violently.
Okay, let's try to tie this market tension to the actual economy. What's happening on the macro front? Because the yield curve did something interesting recently. It was inverted for ages, signaling recession.
Right, the 10-year Treasury yield minus the 2-year yield was negative for a long time. Classic recession warning.
But now it's uninverted. It's steepened again.
Yes, it has re-steepened. The 10-year is now yielding plus 54 basis points more than the 2-year, so a positive spread again. And a lot of people might look at that and breathe a sigh of relief, thinking, okay, recession averted, all clear.
But it's not that simple, is it? The way it re-steepens matters.
It matters hugely. And historically, the re-steepening after a deep inversion often isn't an all-clear signal at all. It's frequently associated with late-cycle dynamics or even the start of a recession.
How does that work?
It's often what's called a bull steepener. That means the short-end yields, like the 2-year, are falling faster than long-end yields, like the 10-year. And why do short-end yields fall fast? Because the market expects the Fed to cut rates aggressively.
And why would the Fed cut rates aggressively?
Because the economy is weakening significantly or is already in recession. So the steepening isn't necessarily signaling future growth. It's reflecting the market pricing in Fed rate cuts in response to economic trouble.
Okay, so the steepening itself could actually be confirming the slowdown the inversion predicted. Are we seeing that slowdown in the actual data?
We are starting to see signs, yes. Manufacturing has been weak for a while. The ISM manufacturing PMI is still below 50 at 49.1, which means contraction.
But manufacturing is a smaller part of the economy. What about services? That's been the engine holding things up.
And that's where the recent data is more concerning. The ISM services PMI, which had been quite strong, has cooled right off. The latest reading was exactly 50.0.
Bang on neutral. Not contracting, but not growing either. Stagnation.
Exactly. The engine seems to have stalled, and if services roll over, that's a much bigger deal for the overall economy.
And this economic softening, this stalling, it creates a huge vulnerability for the market, doesn't it? Because those high valuations we talked about, they're leaning heavily on some very optimistic profit forecasts.
That's the critical link. The whole valuation structure relies on expectations of really strong corporate earnings growth continuing. FactSet consensus estimates, for instance, are projecting, what, almost 11% earnings growth for the S&P 500 this year, 2025?
Yeah, 10.8% for 2025, and then another 13.8% for 2026. Those are big numbers.
Huge numbers, especially if the economy is actually slowing down, like the ISM and the yield curve re-steepening might suggest. If that economic weakness forces companies and analysts to slash those earnings forecasts,
then the E in the PE ratio drops. And to maintain the same PE, the price has to drop too, or the multiple has to compress dramatically.
Precisely. That's how the valuation pillar gets kicked out. If the earnings don't materialize as hoped, today's CPE of 39.5 becomes completely unsustainable very quickly.
And this all loops back to the Federal Reserve, doesn't it? They just cut rates.
Yes, in September 2025, they did a 25 basis point cut, brought the target range down to 4.00%, 4.25%. And they explicitly said it was partly to support the labor market, which was showing signs of softening.
So the Fed sees the weakness too. But here's the rub. They're cutting rates even though inflation isn't back to their 2% target yet. It's still kind of sticky.
That's the really tricky part. Inflation is proving stubborn, staying above target. So the Fed is easing policy into persistent inflation because they're worried about growth.
Which sounds like stagflation.
Yeah.
Slow growth, high inflation.
That is the nightmare scenario risk here. Even mild stagflation is incredibly difficult for financial assets, especially for assets priced for the kind of perfect non-inflationary growth embedded in current valuations.
Okay, let's pull it all together. The synthesis seems to be we're stuck in this unstable equilibrium. Valuations are stretched like a rubber band about to snap.
Yeah, stretched by historical standards.
But for now, factors like maybe decent liquidity, market momentum, And that profound lack of fear measured by the VIX and credit spreads. They're holding the band taut.
For now, it's priced for a Goldilocks outcome, not too hot, not too cold, that looks increasingly like a low probability scenario given the data.
So the crucial question for you, the listener, is what breaks this tension? What are the warning signs, the tripwires that signal the calm is ending and the strategic risks are taking over?
We need to watch a few key indicators very closely. These would signal a real regime shift away from tactical calm towards, well, turmoil.
Give us the levels. What should we be watching for?
Okay, first, the VIX. Forget little spikes. We need to see it move decisively higher and stay there. A sustained move above 25 on the VIX would signal a structural shift. Fear is back, complacency is dead, insurance costs are soaring.
Got it. VIX sustained above 25. What's number 2?
Credit markets need to confirm the fear. Watch that high-yield OAS. If it widens out beyond 4%, that's your signal. It means bond investors, the supposedly smart money, are seriously pricing in a higher risk of companies defaulting. That would shatter the current benign narrative.
Okay, VIX 25, OAS 4%. What about the real economy data, the macro triggers?
A couple of things there. If we start seeing consecutive months of negative non-farm payroll reports, that's a very strong recession signal the Fed can't ignore.
Or if inflation does the opposite of what the Fed wants.
Exactly. If core inflation starts to reaccelerate significantly, that takes Fed rate cuts off the table. It kills the Fed put that everyone relies on. That would be a major shock. And also, keep an eye on that services PMI. If it drops sharply, say, below 47, that indicates a broader, deeper economic contraction is likely underway.
So VIX, OAS, payrolls, inflation, and services PMI. Those are the key dashboards to watch. Given this setup, high, long-term risk, temporary short-term calm. What does this mean for you, the listener? How should you position yourself?
Well, given that the outlook for just passively owning the broad market, what we call beta, does look pretty poor over the next decade based on these valuations, you probably need to shift your focus.
Shift towards what?
Towards quality. Look for companies with really strong balance sheets, low debt, lots of cash, companies with consistently high profit margins, maybe some pricing power, less reliance on debt in the economic cycle.
And use the current calm.
Absolutely. This period of low VIX, tight spreads, it means protection, like options, is relatively cheap. Now is the time, potentially, to think about building hedges, adding downside protection, improving the overall resilience of your portfolio. Don't wait until the VIX is at 30 or 40.
Because by then it's too late, or at least too expensive.
Exactly. The insurance is cheapest before the storm hits.
So the key takeaway is that this weird divergence, this high risk versus low fear, it actually gives investors something valuable. Time.
It does. It's a window. Time to potentially reposition, to enhance quality, to add hedges, without having to do it in a panic.
But the biggest challenge might just be psychological.
Right.
Accepting that this period of calm might actually be the most dangerous time to be complacent.
That's perfectly put. It feels safe, but the underlying conditions suggest it might be anything but. The final question, maybe, for you to ponder is this. Is the market's resilience right now a sign of genuine strength, maybe a new paradigm that justifies these valuations? Or is it simply a reflection of how much risk, and therefore how much future return, has already been pulled forward and consumed? Is the market running on fumes borrowed from the future? Think about that, especially when you look at the handful of mega-cap names driving so much of the index valuation. Are they truly priced for reality or for a perfection that can't last?